Hi, so welcome to the stream today and welcome to our final episode in our IFRS masterclass focusing on IAS 33 earnings per share. In the first episode, we looked at the diluted earnings per share issues, discussing the basic principles that we need to understand when it comes to the share options. We went to the issue in relation to the convertible loan notes and then discussed the principles using some very simple questions. Then in the episode 2 or in the second episode, we then focus on solving a fully fledged examinable question in respect of calculating the diluted earnings per share when we have the share options and the share and the convertible loan notes. Then we also spoke about the issue in respect of right issue. So when an entity makes a right issue, how do we calculate the basic earnings per share? In case you miss any of these, you can check the playlist on the channel under the IFRS Masterclass podcast. You will see episode 1, episode 2 of the IAS 33 lecture, so you can watch the full lecture there. Today, we want to wrap up quickly on IAS 33, looking at how we calculate the basic earnings per share, taking into consideration bonus issue and then issue at full market price. So when an entity makes a bonus issue, or when we are supposed to calculate the earnings per share, and in the question there is a bonus issue, what are we supposed to do? How are we supposed to deal with that? Also, when an entity makes an issue at full market price during the year, how do we deal with that? So some few announcements quickly in respect of what the ICA is doing going into the future. So the first thing is going to be the examination. So registration for the March 2024 examination, it's going to be commencing on the 22nd of January and will be closing on 16th of February 2024. As always, we have 3 centers in Accra. So ICAG College, the Zenith College, and then the UPS, the Accra College of Education near UPSA. So these are the 3 centers in Accra. And in Kumasi, there are 2 centers there. And other regions, the regional capital, we have centers. IC has centers there. Tema, there is a center there. If you happen to be in Liberia, then definitely the capital of Liberia, Monrovia, you will be able to get access and write your exam there. To register, you know that already. You go to your student portal, that is the sms.icag.com, and you'll be able to do your registration. Most importantly will be the examination fee. Level 1 bump up a little bit to 86, level 2 505, level 3 530 Ghana cedi per paper. The examination is going to be taking place between 4th of March 2024 and 18th of March 2024. So these are the few things you need to take into consideration when it comes to the examination. For the timetable of the exam, it's going to be the same issues that you know already. We are going to be sharing that with you as well. If there are any questions you have in respect of the examination, or there is any challenge that you have, as you can see on the flyer here, you can contact the ICAG and you will be assisted in respect of what you have to do to help you to register for the examination. Then current syllabus will be expiring this year, and so the last examination under the current syllabus will be the July 2024 examination. So the new syllabus, which is going to be effective, the first exam of that is going to be in November 2024, will be launched on Monday 29th of July 2024, 2 p.m. UPSA. So it tells you also that in case you are still on the edge, trying to delay, trying to wait, the new syllabus is coming in. There are a lot of beautiful things in the syllabus, various updates in the syllabus to various subjects, and you're going to love it. But we're going to talk about that after the launch of the syllabus, because that would be very prudent to do. So after the launch of the syllabus, the various things that we have to take into consideration and know about going into the future, we will be discussing that to help you so you can decide whether you want to wait till that syllabus becomes effective in November, or you want to take some actions in March and July and see if you can become a chartered accountant as soon as possible. Now, so let's come into our discussion and then begin the discussion for the day. So we are still on IAS 33 earnings per share. So now we want to go into bonus issue. So when there is bonus issue, how do we calculate the basic earnings per share. So that is where we want to start the journey from today. So bonus issue. Now, bonus issue simply refers to the issue of free shares to equity shareholders. That's all. Issue of free shares, technically, to equity shareholders. That's what we mean by bonus issue. So what does that mean in principle or in practice? It means that we are converting reserves into share capital. That's all. Reserves are being converted into share capital, and this is very common when an entity is seeking to increase its stated capital. They can convert reserve into share capital, especially when the banking sector cleanup and recapitalization was done here in Ghana, raising the minimum capital from 120 million to 400 million Ghana cedi. What happened was that many of the banks didn't have to inject significant cash to help them move from the 120 million to 400 million. All they had to do was to convert their reserves into the share capital so that they can meet the capital requirements, and the Bank of Ghana gave an approval for that. So certainly it's something that is common. So it means we are just giving ordinary shareholders more shares, but they are not paying anything for it. Unlike right issue, where they're going to pay below the prevailing average share price of the shares, in bonus issue they are getting new shares, but they're not going to pay anything for it. Now, because it is a free share that we are giving to them, it means that anytime there is a bonus issue, we would have to calculate the bonus fraction. Again, so you realize that for the second time, bonus fraction is coming into the picture. When there is right issue, we calculate bonus fraction, and you saw the way we calculate the bonus fraction under the right issue. Anytime an entity undertakes a bonus issue also, we are going to be calculating the bonus fraction. So how do we calculate the bonus fraction when there is a bonus issue? The formula is pretty simple. It's going to be the number of shares after the bonus issue divided by the number of shares before the issue. Number of shares after the issue divided by number of shares before the issue. What does that mean? Let's give an example. So let's say that we are told that an entity makes 2 for 5 shares bonus issue. What does that mean? 2 for 5 means we give you 2 new shares for every 5 that you are having now, existing or current. Does that make sense? So 2 for 5 means that we give you 2 new shares for every 5 that you are having in that case. So the question we then ask ourselves is, how do we calculate the bonus fraction? Stay with me. The numerator is the number of shares after the issue. So if they did a bonus issue of 2 for 5, that means after the issue, each shareholder will be having how many shares? 7. So our bonus fraction is going to be 7 divided by the number of shares before the issue. How many shares were they having before we did the issue? Existing, which is 5. So our bonus fraction becomes 7/5. So when an entity makes a bonus issue and we are calculating the basic earnings per share, this is how we go by calculating the bonus fraction. And like we discussed under the right issue, the bonus fraction will only affect shares prior to the right issue. So the same principle applies here. Bonus fraction affects shares prior to the right issue. So the total number of shares after the right issue will not be affected by the bonus fraction. Only the number of shares existing prior to the right issue will be affected. That is the idea about bonus issue. So let me bring up a very simple question as well, as it is simple, and then let's see what we can do. Now I'm taking this question from my book in financial reporting or corporate reporting. So what do we have? Let's see. So let's see a very simple illustration here. The requirement here is very simple. It says calculate. Let's zoom that out a little bit so that you can see it well. Calculate the earnings per share for the year ended 31st September 2020. OMG Limited has the following information. Profit after tax has been given to us to be 400,000. Outstanding shares 40,000. On 1st April 2020. Now stay with me. 1st April 2020. This should be 30th September. On 1st April 2020, the entity made a bonus issue of 2 for 1. Okay, so let's crunch some numbers quickly. OMG Limited. Let's see what we got for OMG Limited. So few things quickly. They made a bonus issue on 1st April 2020. So stay with me. If the year ends on 30th September, that means the year will start from where? 1st October. So from 1st October 2019 to 31st March 2020. That is how long? October, November, December, January, February, March. That is 6 months. So for 6 months, they were having the outstanding share of 40,000. Now remember, the nominal value of the share is $1. If it was 0 point something or something like that, we would have divided. But 40,000 divided by 1 is still going to be 40,000. So no cause for alarm in respect of that, right? So for the 6 months, we had 40,000 shares outstanding. Then now from 1st April, when they did the right issue, 2020, to the year ended 30th Sep 2020, I think that will also be another 6 months. So we bring that up, and that is another 6 months. Now, how many shares will be coming? Stay with me. They said they did a right issue of 2 for 3. So we give you 2 new shares for every 3 that you are already having as a shareholder. So what does that mean? So bonus issue, it's going to be 2 over 3 times the number of shares outstanding, 40,000. So we punch that out. What do we have? And I'm getting 26,667. So now it means from the 1st April to the 30th September 2020, the total shares will be the bonus issue plus the outstanding shares. So giving us a total of 66,667. So it means for the second 6 months, or the final 6 months for the year, we are having 66,667 shares outstanding. Does that make sense? That's very important. So that's the starting point. Now, because it's a bonus issue, before we can calculate the weighted average number of equity shares, we need to calculate the bonus fraction. So our bonus fraction, if you remember, we said the bonus fraction is the number of shares after the issue divided by the number of shares before the issue. Now, since the right issue, since the bonus issue was 2 for 3, that means after the issue, you now have 5. So it's going to be 5 over the existing 3. That's our bonus fraction. And like I told you under right issue, and we won't punch this out, because when you punch this out, you have to approximate it, and you are going to be working in decimals. So you want to leave the answer like this, because we're going to work for it later on. So now that we have our bonus fraction, we have the shares, we have the number of periods, we can then calculate the weighted average number of equity shares. So we bring in the period if you want. We bring in the outstanding shares. We bring in the bonus fraction. We bring in the timing ratio. Then we get the average coming up. Sounds good? There we go. So the period, we have the period here. So I'm just going to copy it, as you know already. All right. So the outstanding share for the first period, we said is 40,000. The outstanding shares for the second period, 66,667. Then the bonus fraction will come, which is 5 over 3 here. Okay. 5 over 3. Then the timing ratio, 6 over 12. Bonus fraction will not affect shares after the bonus issue. Okay, that is why we said the bonus fraction affects only shares prior to the right issue. So after the right issue, the bonus fraction will not come in. Timing ratio, 6 over 12. So we multiply up. Remember, we are multiplying everything. That is what is giving us the average. 33,333. Okay. Then we look at the second one, and that is probably 33,334 approximately. So we can then add the two up, and that gives us the weighted average number of equity shares. Weighted average number of equity shares. So 33,333 plus 33,334, and that is 66,667. Okay, 66,667. Now, like I tell you always, don't get any ideas and say, oh, if that is the case, it means that the total share after the issue will always be the weighted average number of equity shares. No. So now that we have this, we can calculate our basic earnings per share. So our basic earnings per share will be our profit after tax divided by our weighted average number of equity shares. And we can work that out. Profit is $400,000. The weighted average number of equity shares we just calculated, 66,667 shares. So we punch that out to get our answer for the period. So I'm getting 5.9, probably $6. Probably $6. Because it's 5.9997. So we can run and make it just $6 in that particular case. So that's how we do with bonus issue. Usually, when the bonus issue occurs at the beginning of the year, then there will be no need for us to do any timing ratio thing. So if the bonus issue occurs at the beginning of the year, all we would do is that, because usually if there is no date in the question, the assumption for bonus issue is that it will be done at the beginning of the year. That's the assumption. So when the bonus issue is done at the start of the year, then your weighted average number of equity shares would just be the outstanding shares plus the issue in respect of the bonus issue that we had. That's all. So let's get a final part, which is going to be issue at full market price. So this is like issue of new shares. Here it's pretty going to be simple. Definitely the issue is going to be calculating your weights. And so you're going to be considering the timing ratio, and then you'll be able to then calculate your weights and get your answer coming in. So probably let me give you a one-liner here before we come. So it refers to the issue of new shares to the public at the prevailing share price of the entity. So let me bring up a very simple illustrative question again for us to see how we do this calculation. Very, very simple here. Okay. Now, so the way we calculate the weighted average number of equity shares will be bring in the outstanding shares. How long has that been in existence? Because the timing ratio will always come into being if the thing is not occurring at the beginning of the year. Okay. If it is occurring at the beginning of the year, then there will not be any timing ratio. But if it is occurring midway or within the year, then certainly timing ratio has to come in. Calculate the earnings per share. If the profit for the year ended 31st October 2020 is $100,000. $100,000. So what do we have? My Love Limited had 10,002.5 shares at the beginning of the year. It issued 4,000 shares at 4.25 per share on 1st March 2020. Okay, so this is a full market price situation, and so you know what you're supposed to do already, and so let's go straight up into it. So if the year ends on 31st October, then it starts on 1st November. So from 1st November 2019 to they did the issue on 1st March, so that means 28th of February 2020. That will be how long? And then how many shares were outstanding? 10,000 shares were there. Now, so November, December, January, February, that's 4 months. Okay, so that has been there for 4 months. Then from 1st March 2020 to 31st October 2020, they did a full issue of 4,000 shares. So now the total number of shares will be 14,000, and that had been there for 8 months. Are you getting the idea? So that is the idea about that. So once we have this, it's issued at full market price, so there will be no bonus fraction headache here. So all we do straight up is to calculate the weighted average number of equity shares. So let me just copy this. So for the first period, number of shares outstanding, it's 10,000. Timing ratio 4/12. Second period 14,000. Timing ratio 8/12. So we multiply up to get the average. That's 333, and that is 9333. And so that gives us our weighted average number of equity shares. So 3333 plus 9333, and that gives us 12,666 shares. But that's not what the examiner said we should do, right? The examiner said we should calculate the earnings per share for the entity, the basic earnings per share, what is happening currently, and that'll be the profit of $100,000 divided by the weighted average number of equity shares, 12,666 shares, and I'm getting $7.9. So that is the idea about issue at full market price as well, and what we do in respect of that. Very sweet, simple, straight to the point.